Silver deliveries are being denied. Not delayed, not postponed, denied. And almost nobody is talking about what that could actually mean. Because if even a fraction of what's happening behind the scenes is real, then the silver market isn't just volatile right now. It's strained in a way that most investors never imagined. You're seeing price spikes. You're seeing headlines about demand. Maybe you're even hearing that everything is functioning normally. But here's the part no one explains. When delivery requests start getting complicated, restricted, or quietly rerouted, that's not just a logistics issue. That's a pressure signal. Silver on COMEX isn't just a price chart. It's a promise, a contract, a system built on the assumption that if someone stands for delivery, the metal will be there. Clean, allocated, transferable, simple. Except lately, simple hasn't been the word. This is where it gets uncomfortable, because the public sees the futures price. $30, $28, $32, whatever the number is that day. But what you don't see is how many ounces are actually available for delivery versus how many paper claims exist against that metal. And that ratio, it doesn't show up on CNBC. You've probably heard the term registered silver. That's the metal eligible for delivery, not just sitting in a vault, not just counted, specifically designated to fulfill contracts. But here's the twist. That pile can shrink quietly. No alarm bells, no breaking news banner, just numbers adjusting in warehouse reports most people never read. And when registered stocks drop while open interest remains high, that's not random. That's tension building. But here's the part. No one explains. Futures markets are mostly settled in cash. The system assumes most traders never want the metal. They want exposure, speculation, hedging. Fine. That works. Until more participants start saying, no, I actually want the bars. What happens then? This is where it gets disturbing. If too many contracts stand for delivery at the same time, the exchange has to source the metal. And if the metal isn't readily available in the right category, under the right warrant, in the right location, things start to slow down. Paperwork gets messy, delays appear, delivery timelines stretch. And that's not even the worst part, because sometimes delivery isn't technically denied. It's redirected, incentivized to roll, encouraged to settle in cash, offered a premium to walk away. Quiet conversations, quiet settlements, no headline screaming default. But ask yourself something. If the metal is there, why offer incentives not to take it? That question alone changes everything. You're told silver is abundant, industrial, widely available. But industrial demand has been rising. Solar panels, electronics, defense systems, medical applications. Silver isn't just a shiny coin in a safe, it's embedded in infrastructure. And when physical supply tightens while financial claims expand, friction forms. Now let's slow down for a second. COMEX isn't some fragile operation. It's designed to manage flows. It has mechanisms, position limits, margin adjustments, emergency powers. But those mechanisms exist for a reason. They're pressure valves. And pressure valves only matter when pressure exists. This is where most people look the other way. Because price action alone doesn't scream crisis. It screams volatility. A spike here, a dip there. Analysts argue about inflation, interest rates, the dollar index, all valid, all surface level. But underneath that surface, warehouse categories shift in ways that rarely make mainstream headlines. Eligible silver can become registered. Registered can become eligible. Metal moves in and out of that delivery-ready pool. On paper, it looks orderly. But if you track the trend over months instead of days, something starts to stand out. The cushion gets thinner. And here's the part no one explains. The futures market sets the global reference price. Not coin shops, not local dealers. The paper market determines the benchmark. So if the paper market experiences stress, the signal transmits everywhere. You might not notice it immediately. But premiums widen. Physical products go on allocation. Delivery times extend. And suddenly the phrase temporary shortage starts popping up more often than it should. And that's not even the worst part. Because when delivery friction appears, confidence becomes the real commodity at risk. Futures markets run on trust. Trust that contracts can be fulfilled. Trust that rules are consistent. Trust that physical supply aligns, at least loosely, with financial exposure. But what happens if participants begin to doubt that alignment? Here's where it gets strange. In past market stress events, other commodities, other decades, exchanges didn't always collapse. They changed rules. They adjusted requirements. They limited certain types of transactions. Not because the system failed outright, but because the system needed to protect itself. Protection sounds stable, but it also signals vulnerability. Now imagine you're a large entity holding significant silver contracts. You request delivery, you expect metal. Instead, you're offered cash plus a premium to settle. You accept. The transaction closes. Officially, everything worked. But what did that transaction quietly reveal? It revealed that immediate physical fulfillment might not have been as convenient as the price implied. This is where it gets disturbing. Silver is historically a monetary metal, not just industrial. It has a psychological role. During periods of monetary uncertainty, investors don't just want exposure, they want tangibility, something outside the digital ledger system. And when that mindset spreads, demand behavior changes. The public sees price fluctuations and assumes the market is functioning. But what's actually happening beneath the chart could be a widening gap between synthetic supply and physical availability. Paper contracts can be created quickly. Physical ounces cannot. And that imbalance doesn't explode overnight. It builds quietly. But here's the contradiction no one likes to talk about. If there were truly a catastrophic shortage, wouldn't prices already be soaring uncontrollably? Wouldn't silver be triple its current level? Maybe, or maybe not. The physical market can tighten while the paper market still absorbs shocks for a while. That "for a while" is the key phrase. You don't need a dramatic default announcement for a system to be stressed. You just need incremental signs. Higher delivery requests, lower registered stocks, more cash settlements, wider spreads between futures and physical premiums. Each one by itself looks manageable. Together, they form a pattern. And that pattern raises an uncomfortable question. Is the silver price showing you the true cost of immediate, deliverable metal? Or is it showing you the price of a contract that assumes most people 1T ask for delivery? That distinction matters more than most realize. Because if delivery is occasionally denied, delayed, or incentivized away, even quietly, the structure reveals something fragile. Not broken, not collapsed, fragile. This is where it gets really unsettling. Markets don't fail loudly at first. They adjust, they compensate, they rebalance. Participants adapt. But every adjustment reveals a constraint, and constraints expose limits. Silver's role in the broader financial ecosystem is often underestimated. It sits at the intersection of industry, investment, and monetary psychology. When stress appears there, it's rarely isolated. It connects to liquidity, to collateral, to leverage. And that's not even the worst part. Because when you zoom out, you notice something else. Rising geopolitical tension, currency volatility, debt expansion, all of it feeds into hard asset demand. Not dramatically, gradually, quietly. So when silver deliveries encounter friction during a period of heightened global uncertainty, that's not coincidence, that's convergence. But here's the part no one explains. A technical default doesn't need to be declared for the spirit of default to exist. If market participants consistently prefer cash settlement because physical fulfillment is inconvenient or constrained, the system slowly morphs from a delivery market into a pricing reference market detached from physical reality. And once that perception takes hold, trust shifts. Trust doesn't disappear instantly, it erodes. Now think about what that means for you. If the reference price is shaped primarily by leveraged paper contracts and physical tightness is managed quietly through incentives and adjustments, then price signals may lag physical stress. By the time stress becomes visible to everyone, the adjustment may already be underway. This is where most people miss the bigger picture. They wait for headlines, for the word default, for a dramatic event. But systemic tension rarely announces itself clearly. It leaks through anomalies, through odd incentives, through delivery categories shrinking faster than they replenish. And you have to ask yourself, why would a mature exchange with decades of infrastructure face recurring questions about delivery in a supposedly abundant market? That question doesn't accuse, it observes, because markets can function under strain for a long time, longer than most expect. But strain changes behavior, it changes pricing dynamics, it changes participant psychology, and that's where it all connects. If silver deliveries are being denied or rerouted in subtle ways, it signals tightness beneath the surface. If tightness exists, while industrial demand remains firm and investment demand fluctuates with macro fear, then volatility isn't random, it's structural. The public sees a metal swinging a few dollars. What's actually happening could be a test of the system's flexibility. Now bring it all together. You have a futures market built on leverage and assumptions about settlement behavior. You have physical supply that cannot expand instantly. You have rising industrial demand and periodic surges of investment interest. You have registered inventories that fluctuate in ways most investors never track. And you have occasional signs that delivery isn't always as seamless as theory suggests. None of these alone equal collapse. But together, they paint a picture of imbalance. An imbalance left unresolved forces adjustment. That adjustment could be higher prices. It could be structural changes in how contracts settle. It could be greater divergence between paper and physical markets. But whatever form it takes, it won't arrive as a dramatic movie scene. It will arrive as a shift in how the system behaves. For the market, that means volatility with a purpose. For the pricing mechanism, it means potential repricing of risk. And for you, it means understanding that the number on the screen may not tell the whole story about underlying availability. The real issue isn't whether a formal default is declared. It's whether confidence in seamless delivery remains intact. Because once confidence weakens, behavior changes. And when behavior changes in a leveraged market, price discovery transforms. That's what the situation actually means. It's not about panic. It's about pressure. It's not about headlines. It's about hidden mechanics quietly shifting under the surface. And if you recognize those shifts before they become obvious, you understand the market differently.